A stock is born when a company decides that in order to grow bigger, it will need a fat injection of cash. The method companies undertake is selling stock to the public. This process is called going public. Understanding what stocks are and how they work is one of the keys to investing. Welcome to the From Zero to Wealth channel. If you are new here, this channel provides you easy to understand information about wealth creation through personal finance and investing, teaching you what schools should have. And if you are returning, welcome back. In this video, we'll be covering what stocks are, how they work, what the different types of stocks are, why you should own them, and the difference between stocks and bonds. Stocks are units of ownership in a company. When you buy a share of stock, you're purchasing a partial ownership stake in a company. A person who buys the stock is called a shareholder. Companies raise capital to fund their operations by selling shares of stock. When you buy shares of a stock in a company, you gain certain privileges depending on the types of shares you own. So it could be voting rights, that means you may have the right to vote at a company's annual shareholders meetings. Dividends, this is the most common one, you receive a share of the company's profits. Or capital appreciation, so when the company's stock price goes up, your shares increase in value. And when the price of a stock declines, the value of your shares fall. By owning shares of the company, you don't have any rights to have a saying in the company's day-to-day activities. To give you a good understanding of what a stock is, here is an example. Imagine that you want to own a bakery, but you only have $1,000 to start. In order to buy the necessary supplies like flour, mixing bowls, measuring cups, etc., you might raise money from friends and family. Let's pretend that 5 of your friends each kick in $1,000. So you have $6,000 in total, and you're able to get the business off the ground. In exchange for the investment, you might agree to give each of them 10% of the business and its profits. This is kind of how stocks work, but then on a much larger level. Private companies go public to raise money for business initiatives such as launching new products or services. They do this through initial public offerings, IPOs, where companies are required to meet SEC financial transparency requirements, and share price is typically decided by an investment bank. Once the IPO has been issued and the stock begins trading, supply and demand dynamics will move its price up or down. Companies issue a variety of different types of stocks. Common stocks and preferred stocks are among the most common varieties, and some companies have different classes of stocks. These different types of stocks determine voting rights, dividend payments, and your rights for recouping your investment if the company goes into bankruptcy. Each share of common stock typically gives holders a single vote at a company's annual meeting. However, common stock shareholders are at the end of the line after creditors and preferred stock shareholders when it comes to recouping their investment should the company go into bankruptcy. Common stock generally entitles you to dividends. However, you are not guaranteed to receive dividend payments. Shares of preferred stock typically do not give you any voting rights, although it entitles holders to receive dividend payments before common stockholder. Investors who own shares of preferred stocks are ahead of those who own common stocks, in line for recouping their investment should the company go into bankruptcy. Companies frequently issue different classes of stocks, such as A, B, or C. Take Alphabet, the holding company that owns Google. Alphabet has 3 classes of stocks, A, B, and C. Class A stocks gets 1 vote for each share. Class B stocks are held by the company's founder and gets 10 votes per share. These shares are not publicly traded. Class C stocks have no voting rights and are largely held by employees and some common shareholders. So why would you own stocks? Owning stocks gives you the potential to share in the profits of the world's most successful companies. Buying stocks isn't without risk. Investors use stocks as one of the core tools to grow their savings and plan for long-term financial goals, like retirement and educational savings. As stock prices go up, your savings balance goes up as well. But be aware that stock prices also go down and sometimes lose all of their value and become worthless. There's no guarantee that you will recoup your investments. Stocks are the basic ways to diversify an investment portfolio. Investors buy different stocks in small and large companies in a variety of industries to help mitigate risk, as different sectors of the economy thrive at different times. For example, a company selling health equipment might experience record sales during an economic crisis like COVID-19, whereas a car manufacturer might have below average sales performance. Owning a variety of different stocks can help investors generate profits in thriving sectors while offsetting losses in others. Buying both stocks and bonds helps investors capture market gains and protect against losses in a variety of market conditions. A bond is a fixed income security in which the investor loans money to the company or local government. Just like a bank loan, a bond contains terms of the repayment of the principal amount of the bond. The way you make money with bonds are as follows. If a bond with a face value of $1,000 pays 4% interest, this means that the bondholder will receive $40 in interest payments during the year. It's just a regular interest payment. Bonds are generally considered to be less risky than stocks. However, bonds do carry the risk of default if the issuer can't make interest payments or redeem the bonds at maturity. Maturity is the length of time in which interest is paid. So simply said, a bond is a loan and a stock is an ownership of a company. If you're looking for long-term growth, having more stocks in your portfolio could be a good strategy given their historically high rates of return compared to bonds. But if you are looking for a steady income, investing more in bonds might be a better approach. That's it for this video, and I hope you've got some value out of it. Thanks for watching, and don't forget to subscribe, like and comment down below if you enjoyed watching. Turn your bell notification on for more series of the basics of investing. We'll see you in our next video.